Okay, guys, so welcome to tonight's session for MAC 4863. So tonight is only for FAC 4863. We're covering share-based payments. Share-based payments is not part of CTA 1. It's only part of CTA 2. So share-based payments have various issues in that standard. The applicable standard for share-based payments is IFRS 2. So make sure you do read it. The standard itself is not that long. Once again, any IFRS standard has the standard itself. It has Appendix A, which is the definitions, and Appendix B, which is the application guidance. So the standard itself, um, that is not that long. And then you will have the long part, which is the application guidance. Remember, all three makes up the entire standard. So make sure you do start reading your standards. It's going to become important. So we're going to be covering the high-level overview of IFRS 2, how to think through it. We won't cover every aspect because we're going to sit here for 3 to 4 hours just covering the theory. So we're going to spend a high level on the theory, on the important stuff. There's going to be about 3 things I'm not going to mention. In another lesson, I will try to bring it through in a question. So there's going to be 3 aspects I won't cover, but the remainder I will cover. And then we will go into a question, a 15-mark question in the TAT letter that I sent you. Now, it's important that you work through financial instruments. It is important that you work through share-based payments. What you would notice that financial instruments will be about 20 to 25. Share-based payments will be about 10 to 15 marks. So that they will make up about 30 to 35 marks out of the 40 marks. Then the remainder 5 marks will be foreign currency, okay, that whatever it's called, changes in foreign currency. So the remainder will be that. Alternatively, they will include foreign currency in the financial instruments question, but it will still be about 5 marks. So just take a note, share-based payments, financial instruments is big topics. So make sure you cover them. The importance with financial instruments and the importance of share-based payments, there's 2 significant things. Number 1, it is a major topic. And then number 2, there are different issues that's within those standards. So this is one of the topics where you can't just do 5 papers. This is now one topic, same like with valuations. This is one topic we will have to do more than 5. Why? Because there's more than 5 type of scenarios. Whereas with WAC, capital budgeting is the same thing being tested. Just here and there they change it. But with share-based payments, with financial instruments, there are different types of questions. The nice part of financial instruments, one question almost covers everything. So you don't have to do a million questions. 5 should be sufficient. But with share-based payments, because one question of 15 marks generally only covers one aspect. There's probably going to be at least 5 different aspects when it comes to share-based payments. So you will have to do a number of questions. Unfortunately, unlike financial instruments, one question doesn't cover many aspects or many principles. With share-based payment, 115 marker is going to cover one major aspect. So just take note of that. But let's go into it. We're going to try to be as quick as possible with the theory so we can get into the application by applying it to a question, and we spend a little bit more time over there. So let's get straight into it. So remember, IFRS share-based payments is dealt with under IFRS 2. IFRS 2 is the objective of IFRS 2 is to provide us with a guidance in as to how to deal with a transaction where a company settles via a share-based payment. So typically it's going to look something like this. So we're going to deal with recognition. How do you recognize a share-based payment transaction? So you will recognize a share-based payment transaction as follows. What would happen is you would acquire an asset, or you would incur an expense. So when you acquire an asset, or when you incur an expense, you're going to say debit asset, or you're going to say debit expense, one of the two. So if you incur an expense, expenses increase. An increase in an expense decreases profit or loss. A decrease in profit or loss decreases equity. Equity decreases on the debit side. So when you incur an expense, you will say debit expense. When you acquire an asset, assets are increasing. Assets increase on the debit side. So therefore you say debit asset. For every debit, there will be a credit. Now, typically, how did we deal with a credit? Before share-based payments, we dealt with a credit by saying credit bank if we paid in cash, or we will say credit payables if we're going to pay later on. Okay, so we acquired or incurred we acquired the asset or incurred the expense on credit terms. Now we are not paying cash, nor are we paying we're not paying purely cash. We may pay cash, but we're not paying purely cash, and we're not paying on credit. Okay, so how you're paying in terms of a share-based payment. Now there are two types of share-based payments: an equity settled share-based payment. So equity settled mean you are settling with shares, with equity instruments. And then you have a cash settled share-based payment. What is that? You're going to settle in cash. So the credit will either be an equity settled transaction, and if it is an equity settled transaction, you will credit a share-based payment reserve. The share-based payment reserve is an equity balance. If it's a cash settled transaction, then you will credit. Let's get me a tissue quickly. Let's give me a tissue quickly. So we are saying if it's a cash settled transaction, the credit will go to share-based payment liability, a liability. So the credit will either be a liability or it will be equity share-based payment reserve. So how do you determine if the transaction is settled in a cash-based? If it's cash settled, then it will be a liability. If it's equity settled, it will be share-based payment reserve and equity balance. So what's important, if you're going to pay using actual shares, or not actual shares, any equity instruments, so options or shares, then it is an equity settled. If you're going to pay cash, but the cash is based on the share price, that becomes a share-based payment reserve. So that's the difference between pure cash and a cash payment that is based on the share price. The moment you see you paying cash and the cash amount that you're going to be paying is based on the share price, then it is a share-based payment that is a share-based payment transaction, and more specifically is a cash settled share-based payment transaction. So that's the big picture. Debit asset or debit expense, credit share-based payment. The share-based payment is either share-based payment reserve, which is equity, if it's equity settled, or the credit is share-based payment liability if it's a cash settled transaction. So that's the big picture. The complication comes in is determining the actual number, the value. So now let's go on. Let's do the easy one first. Let's do cash settled transactions. Cash settled you must get 100% for, which is very easy. Okay. The complication lies in equity settled transactions. So when there's a cash settled transaction, what makes it a cash settled transaction? It first have to be a share-based payment transaction. What makes something a share-based payment transaction? When the settlement amount is based on equity instruments. So in a cash settled, the cash that you're going to be paying is based on the value of the company's shares. So just take note of that. So we will say debit, asset or expense, credit, cash settled. At what amount do you determine? It is based on the fair value of the goods received. Okay, so it's based on the fair value of the goods or services received. So if you acquire an asset and you know the fair value of that asset, the debit to asset will be the fair value of the goods or services you received, and the credit will also be based on the fair value of the goods or services received. The moment you don't know, then you will use the fair value of you'll use the fair value of the share price. What's important to take note? What's important to take note? In a cash settled transaction, every single year, if a service is being provided and the transaction is settled via a cash settled share-based payment transaction, then you will have a fair value adjustment at every reporting period. Okay, so that's simple. Debit expense, credit, share-based payment liability. And then every subsequent year, you will use the fair value, you'll use a fair value. Okay, so that's important to take note. And that's cash settled, sorted. Now we're going to deal with a more complicated one, and that is equity settled transactions. The simple principle is as follows. This is a simple principle, but it becomes complex as we go more deeper into it. So the simple principle is, let's say you acquire an asset. You're going to say debit asset. And since you're going to settle the asset using equity instruments, it is a share-based payment transaction. More specifically, it is an equity settled share-based payment transaction. What makes it an equity settled share-based payment transaction? The fact that you are going to be paying using the fact that you're going to be settling the amount of the asset using equity shares. Now, once you issue, so the question now is at what amount? You say debit, asset, credit, share-based payment reserve, equity. The question is what amount? IFRS 2 says the principle is that when you have an equity settled transaction, the goods or services that you are receiving. So if you're buying an asset, it's a good. If you're receiving a service, then it's a service. So the goods or services that you are receiving will be measured at the fair value of the goods or service received. Okay, so that's important. The debit to asset and the credit to share-based payment reserve, equity, is going to be based on the fair value of the goods or services received. So if they say, dear student, please discuss, you must tell them that. Okay. Then the standard goes further and it says, if the fair value of the goods or services received cannot be determined reliably, cannot be measured reliably, then you will use the fair value of the equity instruments itself. Okay? So where this will typically take place is when you are dealing with employees. So many companies, depending on once you get to a certain role size in the organization, you would part of your remuneration package would be shares in the company, or they will give you options. So what's the difference between shares and options? Shares is the actual shares of the company. An option is a financial instrument, is a derivative that gives you the right to purchase the shares at a given amount. So whether they give you options or whether they give you actual shares, that can form part of your remuneration package. So as a result, part of your services are being compensated with a share-based payment transaction. As a result, part of your payment, part of your remuneration is an equity settled transaction. They're not paying you cash, they're giving you shares. Now, remember the principle says if you are incurring an expense, so you understand that a salary is an employee cost is an expense. So you will say debit employee cost, P&L, credit share-based payment reserve because it's an equity settled transaction. The principle says, what do? You recognize the goods or services received based on the fair value of the goods or services received. If you cannot determine the goods or services received reliably, if you cannot determine the fair value of the goods or services received reliably, then you must use the fair value of the equity instruments. The standard makes it clear that it's highly unlikely that you will be able to determine the fair value of the services you are receiving from an employee in exchange for the share-based payment transaction. As a result, when we are dealing with employee costs, when we're dealing with an employee cost that is settled with equity, the value we place on it is not based on the services the company is receiving from the employee because they're unable to determine the fair value reliably. They would have to determine the fair value of the equity instruments granted. So just take note of that. In most questions, we're gonna work out the value based on the fair value of the equity instruments granted. Why? Because most of the questions is going to revolve around an employee share scheme. But what you must keep in mind that the general principle is the fair value is measured using the fair value of the goods or services received and not the goods or service and not the fair value of the equity instruments granted. You only measure based on the fair value of equity instruments granted if you are unable to reliably measure the fair value of the goods or services received. However, for employee costs, it is assumed that you cannot determine the fair value reliably, and as a result, for every employee cost that is an equity settled transaction, we use the fair value of the equity instruments granted. Very important. Okay, so just don't confuse that. And the rationale for it is that in many cases a bonus is given in equity shares, or even just in normal remuneration. It's very difficult to determine what is the value of the services received specifically relating to the equity instruments that is part of the remuneration package. So you're unable to determine it, or it's highly unlikely that you'll be able to determine it. And as a result, the standard says just use the fair value of the equity instruments granted. Now, what's important to take note over here, the date that you use, you must work out the fair value at the grant date. The grant date is when the employee becomes part of the share scheme, and the share scheme becomes operative. Okay, so it's now they have a right to whatever the share scheme is. That is the grant date. So the value you base your equity instruments on is based at the grant date. So that's important to take note. Now we come to some complications. The question we need to ask ourselves, with these equity instruments, is there a vesting period or not? Or we put it this way, is there a vesting condition or not? If there is no vesting condition, then you recognize the fair value of all the equity instruments granted immediately. So let's say I work for Old Mutual, and part of my remuneration package is that I get 10,000 shares. If Old Mutual have no vesting conditions, they don't place any vesting conditions. So basically, I have a right to use the shares immediately. Then Old Mutual will recognize the value of that share-based payment immediately. So 10,000 shares multiplied by, let's say, 1 Rand for the fair value of the equity instruments at the grant date. So you will recognize 10,000 Rand immediately. Debit employee costs, 10,000 Rand. Credit share-based payment reserve, 10,000 Rand. They do it immediately. But if there is a vesting condition is that certain criteria needs to be met, then you must recognize the value over the vesting period. Now, there are two types of vesting conditions. You have a service condition or you have a performance condition. A service condition is where they only require you to remain in employment for a certain number of years. So let's say 2 years. So in this case, if I can only benefit from I can only make use of the share, the options or the shares after 2 years. That means the standard says you will then recognize the value of the 10,000 Rand over 2 years. So it is 10,000 shares at 1 Rand each. The fair value of that shares never change. The fair value remains the fair value at grant date. It never change. Not in year one, not in year two, even if the actual share price changes. You will just base it on the grant date fair value. So what would happen? Over the 2 years, at the end of year one, they will say debit employee costs, 5,000 Rand, 10,000 multiplied by 1 divided by 2, 1 year out of 2 years, and credit share-based payment reserve, 5,000 Rand. At the end of 2 years, the full 10,000 Rand can be recognized, but remember, they already recognized 5,000 Rand in the previous year, so we only recognize the difference. Okay, so that is what you will do. That is a service condition. A performance condition is a vesting condition where there is a minimum period you need to work and some performance related condition. So for example, it could be that revenue must increase by 20%, or profits must increase by 10%, or the share price must go up from 10 Rand to 15 Rand. So anything other than the number of years you need to work, that is considered a performance condition. Once again, if you have a performance condition, the company will have to estimate when they expect that performance condition to be achieved. Let's say 5 years. Okay, and in order to benefit, you must achieve that performance condition, and you must still be in employment at that date. So in 5 years' time. So as a result, you at the minimum you need to be there for 5 years. So what you do, once again, you will recognize that 10,000 Rand over the period of 5 years. So that would then be 2,000 Rand per year. So that's the basic idea when it comes to equity settled share-based payment transactions. However, a performance condition could include a market condition or it could be a non-market condition. A market condition is the share price. So when you work out the value of equity instruments, when you work out the value of the equity instrument at the grant date, that fair value will include any market condition, so like the share price and so forth. So we don't still bother with that. However, when it's a non-market condition, so for example, the number of share, you must increase the share price, you must increase your, what is it? You must increase your revenue figure, your profit figure. That's a non-market condition. It is specific to the company. Then that will not be taken into account when you work out the fair value of the equity instruments. So the way we factor that in is at every year end, there's two assumptions we need to test. Number one, the number of employees that will be in employment is we need to ask ourselves the number of employees that we expect to remain in employment at the end of the 5-year period is still the same. So we need to change based on that. And then number two, we need to factor in the number of shares that will actually be issued. So those are the types we'll have to consider. But we will cover that now when we deal with the question. The last thing I want to go through is a modification. I'm not going to deal with modification over here because it is not going to make sense just by explaining. I will explain it when we deal with a modification in the question. So what you need to know how to recognize a share-based payment transaction. It is simply going to be debit expense if you're incurring something, or debit an asset if you're acquiring something. If you're acquiring an asset, if it meets the asset definition and recognition criteria, it will be an asset. If it does not meet the recognition criteria of an asset, it will be an expense. So you will debit expense or you will debit an asset. The credit will either be share-based payment reserve if it's an equity settled transaction, or a liability. You can call the liability whatever you want to. It will be a liability if it's a cash settled transaction. An equity settled transaction, we explain how to deal with it. A cash settled transaction, I was going to cover one more thing. And then under equity settled transactions, we will deal with modification. So there's three things so far: equity settled, cash settled, and a modification of an equity settled transaction. Then there's three more things that we must still cover. We'll do it in another lesson, or I'll do a recording on it. I'll see whether I'll be able to have another lesson live or whether I'll do a recording. There's three more other things, and it is applicable for you guys. Number one, it is a group transaction. Okay, so it's a group thing. It comes through in fact 3, even though it's group related. So what would happen is, so if you think about it, so if you look on the JSE regarding Signia will be Signia Limited. Okay, so they are the listed company. Signia Limited is the listed company. But Signia Limited is basically the holding company. There's no activity happening over there. Okay, no real operating activity happening over there. The operating activities is in its subsidiaries. So for example, you have Signia Limited, which is a JSE listed company. It's effectively it is the holding company of its operating subsidiaries. The operating subsidiary, two of them, Signia Life and Signia Asset Management. Now there's hardly any employees in Signia Limited. The employees is sitting in the operating companies, Signia Life, Signia Asset Management. Now, for example, the executives, like the top management, they got shares. So I think like the financial director, I think he is in, or let's just say the head of finance, he is sitting in Signia, they include him in Signia Asset Management. Okay, so he's not employed by Signia Limited. He's employed by Signia Asset Management. But there is a share scheme for management. So like the head of finance is part of management, so he has shares. But the shares he's getting is not Signia Asset Management shares. It is Signia Limited shares. So he's employed in Signia Asset Management, but the shares he is granted is Signia Limited. So IFRS 2 have the accounting treatment as to how to deal with a share transaction of that nature, how to deal with it from Signia Asset Management's point of view, as well as Signia Limited's point of view. So you're going to have two types of transactions, and it won't be exactly the same. It's not necessarily going to be the same answers. It depends. In the one entity, it can be an equity settled transaction. In the other entity, it can be a cash settled transaction. In the standards one page, it's quick to read it, but we will cover it. I'll cover it in another lesson. Then the other two falls under one heading. It is basically what they call it is some alternative, right? So what would happen? The agreement says that the share-based payment transaction could either be settled with equity or with cash. So that is what it says, either equity or cash. Okay, but why is it two parts? The one part is that this option is at the is at the is this option, the holder has the option to decide. Whereas on the other side, the company itself have the option to decide. So as a result, there will be different ways of treating it, because certainly the holder will take the most favorable option for themselves, and if it's the option of the entity will take the entity will choose the option that is favorable on their side. So there's some specific criteria that we will have to work through. So we're not going to cover that now. That's more on a specialized, but you must know it. I actually just need to confirm whether that one needs to be known. I want to check the psych handouts, the psych what they call it now. Um, can't remember what they call it. The psych guidelines, something else they call it. So psych will tell you what is excluded. So like for some universities, like for example, like UCT, the University of Pretoria and so forth, they don't necessarily only cover what psych expects. They maybe go beyond if they know the real world encounters it quite often. So like I know we covered it at UCT, and I know like the University of Pretoria also cover it. Um, but I'm not 100% certain. I just need to check, confirm whether that aspect is actually examinable or not. But definitely the group one, where the parent settles on behalf of the subsidiary, that would be in the scope. But we will cover that in a separate lesson. So for now, we're going to deal with equity settled with a modification. And what you must also be able to deal with is a cash settled transaction. I'm going to check one more thing on cash settled transaction. I think I made an error in what I explained something. Yeah. So the cash settled transaction, I think, if I remember correctly, I said you measure it based on the goods or services received. That's not correct. You recognize a cash settled transaction, debit asset or debit expense, credit liability, based on the liability. How do you determine the liability? The liability is based on the value of the shares. So for example, they may say that you acquire something today and you're going to pay it at the end of the year. And you're going to pay you're going to pay a cash amount based on the value of 10,000 shares. So your liability will be based on the current share price of the shares multiplied by the number of shares. That's the physical cash that you will be paying. So every year end, you will just remeasure it, and the gain or loss, you will just say, you will debit the expense, whatever, and you will credit the liability. The fair value gain or loss on the remeasurement of the liability will go through profit or loss. Okay, you're not going to change the asset or the liability. You're not going to change the asset or the expense. You're not going to change the amount of the goods or services received. All you are changing every year end is the liability amount, and that fair value gain or loss will go through profit or loss. It won't change the amount of the asset. It won't change the actual expense. Okay, so just take note of that. So I'm going to stop there, and we're going to go into the question now. But before we go into the question, I'll tell you which question it is. I think so the data sent you is on page 132, Lily Ltd. So you can open it in the meantime. While you guys open it, do you have any specific questions you'd like to ask me? Ryan, Felice, Tandy?
No, no questions.
Faid, Fakir, Lorato?
No
No
questions.
question.
Okay. Anything confusing at this point in time? Faid, Fakir, anything confusing at this point in time?
Not at the
Can't hear you.
moment.
What you say? Okay, I'm not hearing anything you're saying. I can see you speaking, but
Nothing yet.
okay. Okay, I kind of got then my thing restarted. So what we'll do now, we'll go into the scenario. So page 132, Lily Ltd. I'm gonna give you 2 minutes, 5 minutes to read it, then I'm gonna read it with you. I'm gonna take it nice and slow. Tell me once you're done reading, and then I'll read it with you afterwards. So page 132, Lily Ltd. So only one page. So should it take you long? Are you guys done? You guys done? Okay. Before we go into it, I'm going to split you up into groups, and then you're going to discuss certain stuff for me. Okay. So I'm going to split you up into 3 groups, and then I'm going to tell you what you need to discuss. One person, I'll select the one person that is going to report back to me. I'm going to give you 5 minutes. So please join. Please join your group. You should have it. Okay. Room 1. Room 1, you will discuss your understanding of equity-based equity settled. Room 2, you will deal with room 2, you will deal with cash settled. No, sorry, room 1, with your list there now, room 1, cash settled. Room 2, equity settled. Just your quick understanding. Okay, guys, welcome back. So quickly, like just in 1 minute. Remember, we're not worried about whether you're not 100% certain. We just want to hear what you have to say so we can all learn. Don't be afraid to make mistakes. We're gonna learn. We all will learn from that. Okay. So we're gonna go with room 2 first. So from room 2, either Ryan or Valise can give feedback. You guys can decide which one. Who's gonna take it? Ryan or Valise?
Alpha is we didn't discuss anything. What specifically were we supposed to discuss? You said you were gonna tell us what to discuss.
I sent a message in the groups.
In the groups.
Yeah.
No, I don't. I
You-
don't know if I saw it. I don't know. Maybe the other saw it,
okay.
but we didn't discuss
Do you want to give it a
anything.
try? So group room 2 was supposed to discuss equity settled. Um, so what did you just keep quiet for 5 minutes? Hey? Room 1?
Equity settled. I'm not sure. I can't give.
Okay, it's fine. So you just said you were 5 minutes and what you call it. Okay, it's fine.
I was actually reading the scenario. I was waiting out.
Oh,
Sorry,
okay.
man.
It's fine. Room 1, what did you guys do? You guys also just wait. Or did you see the message? Ashita, you want to give it a try there? Okay, Fakir.
Oh no, you chose the sheet.
Ashita. Oh, it doesn't matter. Did you guys discuss something? Fakir?
Yeah, we did. We discussed the cash settled.
Okay, so you guys saw the message. Okay, so Ashita, can you give
Okay,
us
so
feedback?
Okay, we didn't discuss it for a long time, but what I understood was cash settled, there must be a share-based payment. And we said that we would debit the asset or expense and we would credit the share-based payment as a liability. And the amount would be at the fair value. And every subsequent year, we would do a fair value adjustment depending on the if it's an increase or decrease.
Okay, fair value on what? So you said you're going to have it at fair value, but the fair value of what?
Value on the liability.
And how do you get the fair value of the liability?
it's based on the value of the equity of the company, the share price of the company.
Okay, so that's important. You must mention that if you discuss it. So what you will pick up if you go through a number of the years of questions, right? A lot of the questions is discussion. 15 marks, just discussion with some calculation. So make sure you write the important points down. And when it comes to discussion, write in bullet points, but make sure you get the important points down. Okay, so just make sure about that. Okay, so room 2, you off this time. You got away this time, but next time you're not going to get away. We're going to still make you answer, even if you are quiet in your discussion group. So I'm going to switch now over to the scenario, and I'm going to read it with you. Okay. And if you can make, after each paragraph, I'm going to give some important points. So, and this is how you want to read it in an exam as well, so that you're not overwhelmed and confused. There's going to be a lot of different stuff happening. So each paragraph will probably have some important points. So somehow make a note of it or something of that nature as I go through it. So they say on 1 March 2011, Lilly Ltd granted Miss Lilliam, an executive director, 10,000 options which vested immediately, as well as 30,000 shares on condition that she remains in the employment of Lily Ltd for 3 years. Ms. Lilliam indicated that she has no intention to leave the company within the next 5 years. So there's a number of important things over here. In that first part of the first sentence, we said 1 March, they granted shares and options. So 1 March 2011 will be the grant date. That means subsequently we don't change the share price. We don't change the value of the shares. We keep it based on the fair value at grant date. So very important. So when it's an equity settled transaction, we are interested in the fair value at grant date. So the grant date is 1 March 2011. What did they give her? We know they gave her equity, but they gave her 10,000 options and they gave her 30,000 shares. 10,000 options and 30,000 shares. That is what they gave her. So options. So remember, when it comes to equity settled, we want to determine whether there are any vesting conditions or not. So for the options, there is no vesting conditions. So that means the expense relating to the options will be recognized immediately. Why? Because there's no waiting period. Okay, that the executive, the executive director can exercise her options immediately. She don't have to wait for a certain period. Then the shares have a vesting condition. Remember, you get 2 types of vesting conditions: a service condition or a performance condition. A service condition is where you only have to wait a certain number of years. You don't have a waiting period. A performance condition is where you need to achieve some target, plus you have a waiting period. Okay, so in this case, it is only a service condition because you only have to be in employment for the next 3 years. So that's important to note. Then they're telling you that she have no intention to leave the company within the next 5 years. Why is that important? When it comes to equity settled, the company needs to estimate how many employees will remain in employment. So every year end, they will estimate how many employees they expect to remain in employment at the date when the vesting period is over. Okay, so she have a 3-year vesting period. She don't expect to be leaving in 5 years. So you can see she's going to be here throughout the vesting period. So therefore we can recognize her equity settled transaction over time. So when it comes to the options, it vests immediately. So we're going to say debit employee costs, credit share-based payment reserve equity. Is going to be 10,000 options multiplied by the fair value at grant date relating to the options, plus at so we'll do this at year end, right? Plus at year end, with the 30,000 shares, we can't recognize the full 30,000 shares because she needs to be in employment for 3 years. So how are we going to work it out? We're going to say we're giving her 30,000 shares at the grant date fair value of the shares. But how we account for the period, we will say multiplied by 1 divided by 3. We've only covered 1 year out of the 3-year vesting period. So that is happening in year 1. Okay, so on 28 February 2012, that's the end of year 1, we will do that journal entry. Debit employee costs, credit share-based payment reserve equity. The full 10,000 will be recognized for the options. Why? There's no vesting period. When it comes to the shares, there is a vesting period. So that full amount we will spread over the vesting period, which in this case is 3 years. So after year 1, we will recognize 1/3. And why we can recognize it? Because we expect her to be in employment at the end of the 3-year vesting period. How do we know that? because she said she has no intention to leave within the next 5 years. That is paragraph 1. Now we come to paragraph 2. So remember, it's important to keep your financial year in straight now. Our financial year is running 1 March to 28 February. So our first year was 1 March 2011 to 28 February 2012. Here they say 1 September 2012. So that is in the second financial year. 1 September 2012, Miss Lilliam exercised 5,000 options. 5,000 options from the option scheme 1 at an exercise price of 20 Rand per share. So what's happening? She has these options. So now she can exercise the options and convert it into shares. But the way she converted into shares is by using the exercise price in the option. So what would happen? An option gives you the right to acquire shares. So let's say, so in this case, her exercise price is 20 Rand. So what you would do when you have options, and your option would have an exercise price, meaning when you convert the option to a share, the price you pay is based on the exercise price. So the only time you would exercise your right is when the exercise price is less than the current share price. So let's say the current share price is 50 Rand. You will exercise it because you can buy it for 20 Rand and immediately sell it for 50 Rand. So you make a 30 Rand gain immediately. So that is when you will exercise. So we call that the options is in the money. However, if your exercise price is 20 Rand and the share price is currently trading at 15 Rand, why are you going to use your exercise price? Why are you going to pay 20 Rand where you can go directly into the market and buy it for 15 Rand? So no normal person is going to exercise the option. In that case, we say the option is out of money. Okay, so just take note of that. So she can exercise her options because remember, there's no waiting period. So she could have exercised it on the day she got it because there was no vesting period, no waiting period. So on the 1st of September 2012, she exercised her shares, right? What did she do? She exercised 5,000 options. So she's going to give the company money for 5,000. So 5,000 times 20 Rand. And what are they going to give her? They're going to give her shares. So the journal entry over here would be debit. The journal entry over here would be debit bank because they're receiving money. And you would credit shares. Okay, so just take note of that. Okay, and they're saying Ms. Lilliam did not exercise any of the remaining options before it expired on 31 August 2013. So she only had until 31 August 2013 to exercise the options. So she didn't exercise the remaining 5,000. So when 31 August 2013 takes place, the options fall away. It expires. So when the options expires, there's no cash is happening. What you would do, you would simply remove it from share-based payment reserve. You will say debit share-based payment reserve, which is no longer there, and you will take it to some other equity balance, and typically you'll take it to retained earnings. Alternatively, you may just leave it there forever and ever. There's no need to remove it. But most companies take it out of share-based payment reserve because they want the share-based payment reserve to only reflect that which can still be exercised, and therefore they take it to another reserve account, typically retained earnings. So there will be 2 journal entries over here, one on 31 September 2012 when we get the cash, and one on 31 August when we cancel the remaining 5,000 options that Ms. Lily did not exercise. Then we say, third paragraph, Ms. Lilliam was in the employment of Lilly Ltd for 2 years when major shareholders pressured Lilly Ltd to end share-based payment schemes to employees with no criteria other than continued employment. Okay, so they are just pressuring, nothing much over here. As a result of the pressure, paragraph 4 takes place. Accordingly, Lilly Ltd cancelled Share Scheme 1 on 28 February 2013 at a payment of 12 Rand per share and granted 60,000 shares to Mrs. Lilliam as a replacement for the cancelled share scheme. So when you see that replacement, when you see something is cancelled and they replace it, they replace the cancelled scheme, then this will classify as a modification. Okay. So now into modifications. With a modification, there's two steps. Step number one, the old scheme needs to be fully recognized. So remember, the old scheme was going to be recognized over 3 years. So the options recognized immediately. So we're happy with that. Nothing to worry about that. We recognize it immediately. But the shares was recognized over a period of 3 years. So year one, ending 28 February 2012. Year two, ending 28 February 2013. Year 4 ending 28 February 2014. However, we're not going to reach 28 February 2014 with respect to the scheme, the share scheme 1, because it's being cancelled. When is it cancelled? It's cancelled on 28 February 2013. IFRS 2 requires you, when a share scheme is cancelled, you need to recognize, they call it accelerate the expense. You need to recognize all the remaining expenditure. So remember, you're going to recognize 1/3 at 28 February 2012. That's what we're going to do. Then the second third will be recognized by 28 February 2013. Then the third will be recognized 28 February 2014. But because 28 February 2014 will no longer take place because the share scheme is cancelled, we have to accelerate that expense. So what we do, we recognize the second third relating to year 2, but we will also recognize year 3 at 28 February 2013. We call that the accelerate the expense. Why are we accelerating it? Because there is a cancellation. So whenever there's a cancellation, you will accelerate the remainder of the share scheme that still had to that still would have been recognized had there been no cancellation. Okay, so just take note of that. Then there's a payment of 12 Rand. So what they're doing, they're paying out for the 30,000 shares. So they are saying 12 Rand times 30,000 shares, credit bank 12 Rand times 30,000 shares, and we're going to have to debit an expense. Okay. Then they also granted her 60,000 shares. So now remember, this is a replacement. So they granted her 60,000 shares. So now we're going to apply the 60,000 shares from this new date. The new date, 28 February 2013. But remember, nothing happens on day one. Everything is recognized at the end of the year. So the first time we're going to recognize something relating to the 60,000 shares is on 28 February 2014. What's important, they call it a replacement for the cancelled scheme. That plays a critical role. I'll tell you where that comes into play now. The new share scheme includes a performance criteria, included as performance criteria a cumulative turnover of at least 50 million Rand to be obtained in the following 3 years. So there you can see it's a performance condition. What makes it a performance condition is that it's not solely how long you need to remain in employment, but it's also some target. The target is 50 million Rand. That is a non-market condition because revenue has nothing to do with the market. A market condition would be a share price. Okay. So 50 million Rand non-market condition in the following 3 years. So that means you need to be in employment for 3 years. She will probably have to be there up until it vests, and we have to have a look in terms of the 50 million rand. So say in addition to a service condition of another 3 years before the shares will vest. On this date, Ms. Lilliam still had no intention to leave the company. Okay, so we are happy with that. So when you have an acceleration, if it was not when you have a replacement of the cancelled shares. So when the new scheme is a replacement of when the new scheme is a replacement of the old scheme, then you must the value we use for the share price, we use the net fair value. We will explain that now. If it is not a replacement, then you will use the grant date fair value. This only applies for a modification. So here they say the financial manager calculated that the accelerated vesting expense of year 3 due to the acceleration of the share scheme 1 is 220. You will see we'll be able to calculate this ourselves. I didn't have to give it. And then here, this we would have to calculate, but here they're giving it. The incremental fair value of the replacement award in terms of IFRS 2 is 17 Rand 50. We only use this incremental value, the net fair value, if share scheme 2 is a replacement of share scheme 1. If it is not a replacement, then you must use the fair value at the grant date. So remember the grant date was 28 February 2013. So it would have been, if you look at the table below, it would have been 23 Rand. But it's not 23 Rand because it is a replacement. So just take note of that. Okay, yearly LTD, okay, cool. The only fair value we are interested in is 22 Rand for the shares, grant date, 10 Rand for the options, grant date. Just take note of that, okay? We don't use any other fair value. We may use another fair value if there's a modification in order to calculate the 17 Rand 50, but they gave us a 17 Rand 50. So now let's go into this question. We only do part A, 15 marks. Provide the journal entries to account for all 3 share-based payment schemes of Lilly Ltd from 1 March 2011 until 28 February 2014. Okay, so remember, there's going to be certain dates in between. So every year we will have something 28 February 2012, 28 February 2013, 28 February 2014. But remember, there was a few things that took place. There was she exercised the options on 1 September 2012, and on 31 August options expired. So we're gonna have journal entries for that. The cancelled one is nothing to worry too much about because it's on year end, so we won't miss it. Okay, but just take note, it's also a cancellation or modification. So besides the year-end adjustments, we have 3 other journal entries: modification, the exercise of the options on 1 September, and then the cancellation or the expiration of the expiry of the other options she never exercised. So now let's go into the journal entries. You should be able to see Excel. Tell me once you do. Do you see Excel?
Yes, we can see it.
So remember what's going to happen. We're going to have journal. So 1 March, I'm just going to write this here. 1 March 2011. You don't have to put this here, but I just want to tell you no entries. Nothing happens on the grant date. Why? Remember, we're recognizing in respect of a service being received by the employee. We will recognize a service over time. Nothing happens on day 1. I mean, you can recognize on a daily basis, but then you're going to do accounting. It's going to be crazy. So you only do it at the end of the year after 1 year of service passed. Okay, so nothing happens on day 1. Then we will have 28. Then we're going to have journal entries on 28 February 2012. 12. Okay, then we're going to have again on the new financial year, but before the new financial year, something happened. We had something on 1 September 2012. Then we're going to have another journal entry for the year end, 28 February 2013. Then on 31 August 2013, something happened again. And then finally, at year end, 28 February 2014, we'll have the final journal entry. So every year end, something will happen. And you must just take note if anything happened during the financial year. Like, for example, 1 September and 31 August. So on 1 March 2011, nothing to worry about. On 28 February, we're going to have the following. We're going to say, so we'll have debits and credits. Okay. So what we're going to have on day one, on 28 February, we're going to say expense, employee costs, whatever you want to call it. Remember, you can call it anything, employee costs. And this is going to go through P&L. What we're recognizing, we're going to recognize the 10,000 options that vested immediately. So in year one, we can recognize the full 10,000 options. Then we're also going to deal with the the 30,000 shares. We cannot have the 30,000. We cannot have the full 30,000 shares because there's a vesting period of 3 years. So we're going to spread that over 3 years. But remember, recognition is debit expense or debit asset. There's no asset acquired. We're getting employee services, which are an expense. So we're going to debit an expense and we're going to credit either an equity settled transaction or a cash settled transaction. Because these are equity instruments, it is shares and options, is an equity settled transaction. So we're going to call it share-based payment reserve. Share-based payment reserve. Okay, and what is that? Statement of changes in equity. Okay, now you must work out the number. What is best to do is to use a table. Okay, so when it comes to share-based payments, use a table. So I'll show you how to set it up. Okay, so we're going to use a table. So you want to keep the date. I like to put details. Okay, number of employees. So number of employees, number of shares, and then the fair value. Okay, number of equity instruments. Okay, fair value. Remember, the fair value is the grant date fair value. And then you want to say vesting condition. And this amount will tell you what the share-based payment reserve is. Share-based payment reserve. And this column will tell you what is P&L. Users tables going to make your life easier. Okay, so you will see most solutions, they will use a table, which is going to help you keep track of what's happening. Otherwise, you're going to waste a lot of time and you're going to be confused. So the first date basically would be 1 March 2011. But so you can do it at that date. So let's just do it because it's immediate. So 1 March 2011. This is share options. This only relates to Mrs. Lilliam, so it's one employee. In another question, will be multiple employees. The number of equity instruments, the share options, she's getting 30,000. The grant date fair value was 10 Rand. Did she have any vesting conditions, non-market vesting conditions? The answer is no. Okay, so there's nothing we'll put in over there. So the total will simply be that multiplied by 10. So 10,000. So the share-based payment reserve will equal that number over there. Then on 28th February. So remember, you don't have to recognize anything on 1 March. Technically speaking, you'll recognize something on 1 March 2011, but there's no need to, because remember, 1 March 2011 still falls in the financial year ended 28 February 2012. So on 28 February 2012, that's the only time we can recognize the shares. Okay? That's the only time we can recognize the shares. It's still one employee, but how many shares does she have? 30,000. Then, if you go to that table on the scenario, the market, the grant date fair value of the shares was 22 Rand. Okay, the grant date was 22 Rand. So take note, the 10 Rand relates to the options, 1 March 2011. And the fair value for the shares is 22 Rand. Now remember, we don't change the fair value when it comes to equity settled transactions. We are always using the grant date fair value. In another scenario, they could have given you a calculation that the accountant performed, and the accountant may have changed this fair value based on every year end. Remember, for an equity settled transaction, you stick to the grant date fair value. There is a vesting condition. Remember, there is a vesting condition. The vesting condition is that she must remain in employment for 3 years. This vesting condition at 28 February 2012. 1 out of the 3 years have passed. Okay, so 1 out of the 3 years have passed. So the way you're going to work out the total is 30,000 equity instruments at 22 Rand each. But remember, she can't get the full amount. We're not going to recognize the full amount, but she needs to be in for 3 years. So we multiply it by 1 over 3. So that's how we get the 220. You remember they also gave us a 220 earlier, but that's how we get it. So now at 28 February, so at 28 February 2012, the share-based payment reserve is equal to the sum of these. The profit or loss will be the closing balance, of the share-based payment reserve minus the previous balance. What was the previous balance? There was no previous balance. The previous balance is 0. So therefore, in year 1, our share-based payment reserve is 320. So we're going to go employee costs, 320, 1, 2, 3. And 320. So now we know what our share-based payment reserve balance is. And in year 1, the movement from 0 to 320 will give us our expense, which is that. Now on 1 September 2012, what had happened? She exercised 5,000 options, okay? So she exercised 5,000 options, and she exercised it at her grant date at the exercise price, okay? So just important, she exercised it based on her exercise price. So what would be the journal entry? The journal entry would be as follows. The journal entry on 1 September 2012 would be as follows. Miss Lillian exercised 5,000 options at 20 Rand. So what's going to happen? The company bank is going to go up. SFP. How much is the bank going to go up by? It's going to go up by 5,000 options at the exercise price of 20 Rand. That's the physical cash she will be paying. So that's the physical cash she will be paying. But now remember, included in this 320,000 Rand, included in a 320,000 Rand share-based payment reserve is 10,000 options. Now she have exercised 5,000 of those options. So therefore, the share-based payment reserve needs to now reduce by the 5,000 options that has been exercised, because that is no longer share-based pay. She have exercised it. So therefore, what's going to happen? The share-based payment reserve will now decrease. Share-based payment reserve is an equity balance. Equity decreases on the debit side. How much does it decrease by? It decreases by 5,000 options multiplied by whatever is included in there, multiplied by the grant date value, the 10 Rand. So just take note of that. By her exercising the shares, the company had to issue new shares. So what happens? Share capital increases. Share capital, SCE, increases by how much? The sum of the two. The cash payment plus the transfer from the share-based payment reserve to share capital. So just take note of that. So if we want to update this over here, on 1 September 2012, exercise options. So she exercised options. Okay, I'm just explaining to myself. Still one employee. How many options were exercised? How many equity instruments? 5,000. So remember, this table here is the share-based payment reserve table. So the fair value is still based on the fair value at grant date. Don't use the exercise price because you're going to mess up the share-based payment reserve. There's no vesting condition. So therefore the total, because she's exercising, it's a negative. Okay, so it is 5,000 multiplied by 10 Rand. So it's negative 50. So share-based payment reserve will reduce by that 50,000 Rand. So as you can see, what had happened, we debited share-based payment reserve with 50,000 Rand. So remember, share-based payment reserve is impacted only by the grant date fair value. Don't use the actual exercise price. Please take note of that. That is a fundamental principle, is an important principle. So just be wary. Some exams, they may penalize for that purposes, okay? So the next transaction date is year end, 28 February 2013. Two things happened over here. Okay, so two things happened over here. One, it is just basically the normal shares, okay, the normal shares, the normal annual thing where she's one employee, she has 30,000 shares, the grant date fair value of the shares is 22 Rand. The vesting period now, what's the vesting period now? So remember 2 years basically passes by. So remember 2 years basically passes by. So 2 years basically pass by. So another 1/3. So we work out one employee times 30,000 shares times 22 Rand times 0.33. I think in the previous examples I didn't, in the previous examples, I did not, why is it different? Can you see what I'm doing is different over here? Oh, okay. Go 1 divided by 3. Okay, so 1 divided by 3 to 20. Okay. So just have a look over here. So there you go, 220, 220. Okay, just want to bring your attention. You must also include the number of employees. Okay, so another question will be more than one employee. So we must include the number of employees. Let me just change this quickly. There's another question will be more than one employee. Okay. So we have 220. Then also on the same day, there's the acceleration. How do you spell acceleration like that? Acceleration, okay, due to cancellation. So what would be, remember you must accelerate. What we accelerate, it's one employee with 30,000 shares, 22 Rand. How many years is remaining? So remember, this would have only happened later on, but we must accelerate all the remaining years. How many years is remaining? 1/3. 1 divided by 3. Remember, they gave us the amount, so we could have just plugged it in, but I want to show you how you still get to the amount. We're still going to get to the 220. This 220 over here, highlighted in orange, is the 220 they gave us in the scenario, the accelerated amount. But remember, you could also calculate it. And there was nothing else on that date, so now we can work out. The share-based payment reserve. So the share-based payment reserve is opening balance plus all the movements, which will give me my closing balance. some, yeah. Okay, so just take note of that. Oh, the other thing we must also do, the other thing we also need to do, let me just quickly insert over here. The other thing we must also do is the actual cancellation. Okay, so the actual cancellation. So now I must do the actual cancellation. We first accelerate, then we do the actual cancellation. Once the shares is cancelled, we don't expect there to be any share-based payment reserve. So how many is one employee we cancelling? 30,000 shares. 30,000 shares of 22 Rand each. Remember, we're cancelling everything. So there's no need to put in a vesting period. We have captured all the vesting periods already, the 220, 220, and the accelerated 220. So we've captured the full expense. Now we want to we want to cancel the share-based payment. So what we're going to do, so what we will be doing is doing the actual cancellation. Okay. How do I do this now? Oh, yeah. So we're going to say equal one employee multiplied by 30,000 multiplied by 22,000, but as a cancellation. So therefore we're going to say minus. Okay. So we bring in the 660. So just take note of that. So the balance is 50,000 Rand. Now we want to get the profit or loss amount. Remember, how do we get the profit or loss amount? It is equal to closing balance minus opening balance. So it is, what did I say now? It is closing balance minus opening balance. So therefore, we will have 270,000 Rand that will basically go through the share-based payment reserve. But what's important to take note, what you want to recognize, you will recognize each item individually. Okay, so we're going to have on 1 September, we're going to recognize something. On 28 February, we recognize this one separately. We recognize that one separately. We recognize this one separately. So we must recognize it separately. So let's go and deal with it. So on 28 February 2013, we have already dealt with this 50,000 Rand one. Now you want to deal with a transaction on 28 February 2013. What's going to be, the journal entry will be exactly the same as above. The journal entry will be exactly the same as above. Okay, debit employee costs, credit share-based payment reserve. But now we're going to bring in only the amounts that relate to the yearly adjustment, which is this 22,000 Rand. Okay, it's going to be that 22,000 Rand. What we can also do is also one time bring in the acceleration. Okay, so you can either do the acceleration separately from the other shares, or you can just bring it together. So I'm going to bring it together. So this 440 represents two periods, the 2013 financial year, and then also the accelerated amount that would have been recognized in 2014 had there been no cancellation. So just take note of that. Then my share-based payment reserve, 440. I just want to keep tabs of our share-based payment reserve. So you can see we'll end up with that 50,000 Rand that we expect. Share-based payment reserve. Share-based payment reserve. So we currently have a credit means share-based payment reserve is increasing. So it's 20. Then we have a debit, which decreases share-based payment reserve. Then we have a credit. Okay, then we have a credit of 440. So far we have, what do we have so far? We have 710,000. We expect it to be 50,000 Rand. Now remember, there's some more journal entries on 28 February 2013. What will you still account for that happened in the 2013 financial year? It is the actual cancellation. So far in the 2013 financial year, we recognize the exercise of the 5,000 options. In the 2013 financial year, we recognize the annual normal share-based payment reserve to record what has vested. And then because there was a modification, a cancellation, we also recognize the acceleration of the remaining amount relating to the original share scheme. That is why this is double the amount, okay? Now, what is still in the 2013 financial year is the cancellation. So remember, what are we canceling relating to the share scheme? We are canceling the entire share scheme, not the options, only the shares. Now remember, the entire share scheme was 30,000 shares for one employee at a fair value, at a grand date fair value of 22 Rand. That entire scheme must be de-recognized. So what we're going to do, share-based payments needs to decrease. So we're going to say debit share-based payment. Share-based payment is an equity. Equity decreases on the debit side. So remember, how do we get that? It is going to be the 660. How do we get the 660? It is the full share scheme that we are de-recognizing. One employee, 30,000 shares at the grand date fair value of 22 Rand per share. We are not cancelling the share options. We're only cancelling the shares. Okay, so just take note of that. Now remember, as a result of cancelling the shares, what happened? We paid Miss Lilium 12 Rand for each share. So what's happening? The company's bank is decreasing because money is being paid out. Because the bank is decreasing, assets is decreasing. Assets decreases on the credit side. So we say bank, SFP, credit. How much are we going to credit? 30,000 shares we are buying back. We're paying her to cancel the 30,000 shares. So we're taking back the 30,000 shares and we're paying her 12 Rand. So what is missing? We're missing a 300,000. The 300,000 will just go directly to equity. We take it against retained earnings. So retained earnings will increase. So share-based, so the difference go to retained earnings. If we didn't pay her anything, the full amount gets taken to retained earnings. So remember, when the share-based payment reserve no longer exists, you want to remove it out of share-based payment reserve. However, the accounting standard does not allow you to take it to income. You can't affect profit or loss. What you can do is transfer it from one equity balance to another. So what's the other equity balance? Retained earnings. So that is what we are doing over there. That is just basically the balancing figure. So that is everything at 28 February 2013. On 31 August 2013, what happened on this date? On 21 August 2013, the remaining options expired. Ms. William did not exercise it, and the options expired by 31 August 2013. So therefore, she's no longer able to utilize it. So what's going to happen? We're going to do that. Share-based payments is decreasing because it is the share options have expired. So it's going to be 50,000 Rand. That's the remaining amount. 5,000 options at the grant date of 10 Rand, at the grant date fair value of 10 Rand, which gives us 50,000 Rand. When you transfer something out of share-based payment reserves, you take it to another equity balance, and that will just be retained earnings. So what we're going to do, 31 August 2013, it is options expired, options expire, one employee, 5,000 options at 10 Rand, no vesting period. So we just say one employee multiplied by 5,000 multiplied by 10. Now remember, it is decreasing, so we make it negative. So at this date, at 31 August 2013, share-based payment reserves is 0. So I have a look. Share-based payment reserves is 0. The options, all of them are gone now. Half of it was exercised, half of it expired. The shares of share scheme 1 have been fully cancelled. So share-based payment reserve is 0. There's no requirement to remove it, but if you do remove it, you take it to another equity balance and typically retained earnings. Now we're going to recognize the new share scheme. Now we're going to recognize a new share scheme at 28 February 2014. So at 28 February 2014, we have the new share scheme, share scheme 2, one employee, 60,000 shares. Because it was a replacement, share scheme 2 is a replacement of share scheme 1. We use that incremental fair value, the net fair value. If share scheme 2 was not a replacement of share scheme 1, we'd have used the grant date fair value on 28 February 2013. So remember, we'd have used the grant date fair value for share scheme 2 as at 28 February 2013 if it was not a replacement share scheme. But because it is a replacement share scheme, we use the net fair value or the incremental fair value given to us as 17 Rand 50. The market condition, the vesting period is 1/3, 1 divided by 3. So what would happen? One employee, 60,000 shares, 17 Rand 50, 1/3. So that is that. Nothing else. Now we can work out so we say opening balance plus all the movements, give me my closing balance. My profit or loss is closing balance minus opening balance. But remember, the way we process journal entries is for each transaction. So we already done the 50,000 Rand. We're now going to do the 350. So if we go back to the top, on 28 February, we would simply have this journal entry. Debit employee share scheme, credit share-based payment reserve with a 350. So this is a typical question with share-based payment reserve journal entries. The next typical question is a discussion. So that's all that I want to cover for tonight's lesson. That is how you do a typical equity settled transaction. It's typically going to be an employee, and there will most likely be a modification. We dealt with the modification, we dealt with the normal items as well. The only further complication over here would be the number of employees. Okay, so every year that number would change. Okay, so you might just take note of that. In this case, it just happened to be 1. But the same thing applies when you are doing it. The same thing applies when you are doing it for more than 1 employee. So if you add up this, you will see based on the journal entries, we come to the share-based payment, the closing balance that we expect of 300,000 Rand. So if you go back here to the bottom, you can see the expected closing balance. We have 350. So let's just have a look what's happening over here. Oh, I double counted that 50. So we want 350. There we go. There's the 350,000 Rand. Okay, so just take note of that. Do you have any questions? If you have no questions, then we will leave it here for tonight, and then you can let me know if you have any questions as you do some more question papers. But any questions on your guys' side? Ashita, Faid, Fakir?
No questions.
No questions.
Rebecca, Ryan, Felice?
No questions.
No questions.
Okay, so we're going to leave it over here for tonight. Remember, there's plenty of question papers you have to work through. This is share-based payments. It can be a little bit more trickier, but this is a general share-based, this is, if I can say, a moderate share-based payments question. Not an easy, but far from difficult, okay? Far from complex, but it's a decent one, okay? Can become more complicated. I was looking for a more complicated one. I wanted one like this, but I wanted a bit more complex. I couldn't find. Maybe if we look through some exam question papers, but for now, this should be okay. What's going to be important, you will see a lot of the past papers is a discussion. I wanted to do a calculation first, so you can see how we do the journal entries with calculation. I'm going to try to record another one based on a discussion. So remember, there's, I think, quite about 3 of the past question test papers in the 103 is discussion, 15, 20 marks. So between 10 and 20 marks. So just make sure you're able to discuss, you're able to write it out, explaining what you have to do. Okay. That's all from my side, guys. I'll see you tomorrow for Fact 4862, Fact 4864, revenue. Okay. See you guys. Bye-bye.